Hey everyone, welcome back to another dividend investing video. Are you on the hunt for dividend stocks that not only grow your income, but are also trading at a discount? Well, look no further. In today's video, I'll be sharing 3 undervalued dividend stocks that recently announced dividend hikes, proving they're committed to rewarding shareholders even in this uncertain market. Now, if you're looking for that perfect mix of value and income growth, make sure to stick around because these stocks might deserve a spot on your watch list or even your portfolio. And as always, I'd love to hear from you. Drop a comment below. Let me know what dividend stocks are you buying as we wrap up January, the first month of 2025. Let's get into it. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. The first stock we're covering today is Black Hills Corporation, ticker BKH. Now, Black Hills is an American electric and natural gas utility that serves over 1.3 million customers across 8 states, including Colorado, Montana, South Dakota, Nebraska, Wyoming, Arkansas, Iowa, and Kansas. The company operates an extensive network of electric transmission and distribution lines, gas pipelines, and storage sites, along with a coal mine in Wyoming. Now, with an S&P credit rating of BBB+, a market cap of $4.12 billion, and an impressive track record of more than 50 years of consecutive dividend growth, Black Hills has proven to be a reliable pick for income-focused investors. Over the last year, shares of BKH have climbed approximately 15%, showing a strong rebound in the short term. However, looking at the bigger picture, the stock is still down about 30% over the last 5 years, which could signal an attractive opportunity for value investors seeking that potential turnaround. At the time of publishing, shares are trading around $57, which is close to the midpoint of their 52-week range. I see this as priced at an intriguing balance between potential upside and stability for long-term dividend investors. Now, speaking of the dividend, as I mentioned, Black Hills boasts an impressive 54 years of consecutive dividend raises. This achievement technically qualifies it for quote-unquote dividend king status, though the title is traditionally reserved for the large cap companies on the S&P 500. BKH, being a mid-cap, doesn't qualify just on that technicality. Now, over the last 5 years, the average dividend growth rate has been 5% per year, which I consider solid, especially for a utility company offering a strong, reliable dividend yielding near 5%. Now, on January 24th, 2025, Black Hills announced its 54th consecutive year of dividend growth with a 4% increase. This marks over 5 decades of consistent dividend raises, a testament to the company's reliability and commitment to the shareholders. Now, looking ahead, growth is projected to remain in the 4 to 6% range, offering steady, predictable income for investors. Now, make sure you have your shares by February 14th, that's the ex-dividend date, to receive the upcoming dividend payment on March 1st, which is going to be 67.6 cents per share. Black Hills pays out on a quarterly schedule of March, June, September, and December for a total annual payout, $2.70 per share. SimplySafeDividends.com, they give Black Hills a dividend safety rating of 77, marking it as a safe investment and suggesting that a dividend cut is unlikely. This rating was reaffirmed as of November 11th, 2024. Now, the dividend is well supported by the company's earnings, accounting for 69% of the last 12 months' earnings, and it's projected to take up 63% of the next 12 months' earnings. And for utility companies, we're generally comfortable with this payout ratio being below 75%. And Black Hills comfortably falls within that range, making their dividend coverage solid and sustainable. As of today, shares of Black Hills Corporation are yielding 4.7% with the new dividend hike. This is nearly a full percentage higher than the historical 5-year average yield of 3.72%, which could be an indicator of a potentially undervalued stock. In fact, if Black Hills were to revert closer to that 5-year average yield of 3.72, we would expect the share price to fall somewhere between $65 and $80. So there could be some upside potential in the stock if it was to return to that historical yield range. Now, moving on to the PE ratio, Black Hills currently has a forward PE of 13.9, which is well below the historical 5-year average of 16.3. Another potential indicator that the company is undervalued. It's also worth noting that the PE sits comfortably below the utility sector average of 17.7. Now, if BKH were to trade closer to this 5-year average, we'd expect its share price to fall somewhere between $61 or $74. Of course, it doesn't guarantee the stock will move in that direction, but more often than not, stocks tend to revert to their historical norms over time. And when it comes to debt, Black Hills has a net debt to EBITDA of 5.05 and a net debt to capital ratio of 55%. Neither of these values are particularly concerning as they're within the reasonable ranges for a utility company. These levels suggest that Black Hills is managing its debt responsibly while maintaining a solid balance sheet. Now, Wall Street analysts have an average price target of $64 for Black Hills over the next year, projecting 11% upside from where shares are trading today. So that reflects the potential for growth if the stock aligns more closely with those analysts' expectations. Utility sector isn't necessarily the most exciting, but it certainly has its place for those looking for reasonably stable income. Utilities might not have the same growth potential as the other sectors, some of them, but they are reliable dividend machines. Black Hills Corporation is one that stands out for investors looking to lock in a solid starting yield for a quality company. It operates in some nice growing regions of the country like Colorado and Wyoming. Beautiful places worth visiting if you've never been, a side note. But I'd love to hear from you. Let me know in the comments, are there any utility companies you are liking right now? Because there's a few that look pretty attractive, I think. But I try to focus on those with the strongest dividend growth and fundamentals. That's what I'm all about. The next stock we're diving into today is Elevance Health, ticker ELV. Elevance Health is one of the two largest health benefits companies in America, providing health insurance to over 40 million members. Perhaps best known for the Anthem Blue Cross Blue Shield brand, which is a household name across many U.S. states. With a market cap of $93 billion, Elevance is a massive player in the healthcare sector, operating in various segments like individual and group health insurance, Medicaid, and Medicare Advantage plans. The company's scale and wide reach makes it a reliable and established name in the industry, offering an intriguing blend of growth potential and stability for investors. Over the last year, shares of Elevance Health are down about 15%. Today, the stock is trading just a few points higher than its 52-week low. As of now, shares are priced at about $400 each. Now, I want to point out something important. Don't let a higher share price like this trick you into thinking a stock is expensive. In the era of fractional shares, the share price itself isn't as relevant as it may have once been. The value of a stock is more about the company's overall performance, not just the price per share. Now keep in mind the share price is really largely a function of how many shares are outstanding, not necessarily a measure of valuation. Now Elevance Health has a solid track record of dividend growth. It's 12 consecutive years of increases. Over the past 5 years, the company has averaged an impressive 15% annual dividend growth rate. The latest raise was a 5% increase, announced on January 23rd, 2025. Now, Elevance pays dividends quarterly in the months of March, June, September, and December, with the next ex-dividend date on March 10th, 2025, and the pay date set for March 25th, 2025. The quarterly dividend is $1.71 per share, equating to an annual payout of $6.84 per share. Simply Safe Dividends has awarded Elevance Health a top-tier dividend safety rating of 99, marking the dividend as very safe as of October 31st, 2024, and highly unlikely to face a dividend cut. This safety is backed by the company's robust earnings with an earnings payout ratio of just 20%, and a free cash flow payout ratio is also a low 21%, suggesting ample room for continued dividend growth and sustainability. Currently, Elevance shares are yielding 1.71%, which is above the 5-year average yield of 1.23%, so we are looking undervalued on dividend yield, and while this yield may seem low compared to some high-yielding stocks, it's important to note that the company's 10-year yield on cost is over 5%. This means if you had bought shares 10 years ago, you'd be getting back 5% on that initial investment. And that's thanks to the power of dividend growth. The dividend yield theory suggests a fair value for the stock would be between $499 and $610, assuming the yield reverts closer to those historical norms. The current forward PE for Elevance is 11.5, well below the 5-year average of 13.9, and the healthcare sector average of 16.4. If the stock were to trade closer to its historical PE, we would expect a price range between $435 and $531. This could signal an undervalued opportunity with potential for upside if the stock reverts to its historical valuation. Over the last decade, Elevance has demonstrated a strong commitment to returning value to shareholders through share buybacks. The number of shares outstanding has decreased significantly from 273 million in 2015 to an estimated 233 million in 2025, signaling the company's efforts to reduce dilution and enhance shareholder value. Now, Elevance boasts a return on equity of 15% and a return on invested capital of 14%, highlighting the company's efficient use of capital and solid profitability. Additionally, Elevance has more cash on the balance sheet than debt, which is a positive sign of financial strength. Lots to like here. The Wall Street analysts have an average price target of $496 for Elevance Health, indicating a potential 24% upside from current levels. So the healthcare sector, while essential, it does face some long-term questions and political considerations. This is something to keep in mind as an investor. However, I don't foresee any major changes in the immediate future with the new administration just now taking office, even for, say, the next decade. But Elevance Health stands as a solid player in this sector with strong fundamentals and stellar dividend growth. The stock probably isn't for those looking for more income today, but rather for those with some time on their side. I think Elevance has the compounder potential, making it a good choice for long-term investors. Let's wrap up with our final stock for today. That is CubeSmart, ticker CUBE. CubeSmart is a leading self-storage real estate investment trust, or REIT, with a market cap of $9.4 billion. The company is one of the top 3 owners and operators of self-storage properties in the United States, boasting an extensive portfolio across several states. Known for its high-quality facilities and solid financial performance, CubeSmart has become a significant player in the self-storage space, offering investors a piece of the self-storage business. Over the last year, shares of CubeSmart are down over 7%, and currently the stock is trading close to its 52-week low. This could potentially present a buying opportunity for those looking to invest at a lower price point. CubeSmart is another stock with a sweet mix of current income and growth. Over the past 5 years, the company has averaged a solid 10% annual dividend growth, which is quite impressive. This comes alongside an impressive 15 consecutive years of dividend increases. However, it is worth noting CubeSmart did cut its dividend in the 2008 recession, as many REITs did during that period. Now, fast forward to December, and CubeSmart announced its 15th consecutive dividend hike, a modest 2% increase, bringing the quarterly dividend to 52 cents per share. The company pays dividends quarterly, January, April, July, and October, for a total annual payout of $2.08 per share. One thing to keep in mind is the dividend is non-qualified, meaning it's going to be taxed as ordinary income. This makes CubeSmart a solid choice for tax-advantaged accounts, such as a Roth IRA. In fact, I personally hold some Cube in my own Roth IRA. I've had it for a couple years, and I think it might be time for me to add to that position. CubeSmart currently has a Simply Safe dividend score of 61. This is rated safe. Indicates that there might be a little bit of risk, but the dividend is still relatively secure. One thing to keep an eye on is the company's AFFO payout ratio, which is edged up to 81%. It's a little bit on the higher side, but it's not necessarily alarming. It does help explain the modest recent dividend raise. I believe CubeSmart is going to be able to bring this ratio back down under control in the near future. Looking at the AFFO per share growth over the last decade, we can see steady growth, particularly rapid growth in these last few years. However, it's important to note there was a slight dip in AFFO per share over the last year. So this could be a temporary fluctuation as the company stabilizes, and we may see this growth pick back up again. At least that's what I'm counting on. Now, currently, shares of CubeSmart are yielding 4.99%, which is significantly higher than the 5-year average yield of 4.2%. This creates a compelling opportunity for investors to lock in a nearly 5% yield on this quality self-storage REIT, especially given its solid track record of dividend growth. Using dividend yield theory, if the stock were to revert to its historical average yield, we would expect a share price to fall between $45 and $54. This suggests that CubeSmart might be currently undervalued, providing potential for price appreciation along with solid dividend yield moving forward. CubeSmart's net debt to EBITDA ratio stands at 4.06, indicating that the company's debt load relative to earnings is manageable. The net debt to capital ratio is at 50%, which falls within that borderline range. While it's not atypical for this REIT, it's worth noting that CubeSmart has never exceeded this level of leverage, suggesting they maintain a relatively stable capital structure. This financial positioning gives me confidence that CubeSmart is managing its debt levels effectively without pushing beyond a sustainable threshold. Wall Street's average annual price target for CubeSmart is $49.29, which represents a potential 18.2% upside from its current price. And this aligns with the opportunity for growth, especially when factoring in the solid dividend yield and the favorable P to AFFO and valuation metrics we just discussed. So CubeSmart, I think, offers a compelling investment opportunity, particularly for those seeking a mix of reliable income and growth potential. Increasing its dividend consecutively for 15 years, the self-storage sector remains attractive due to constant demand driven by factors such as population growth, urbanization, making CubeSmart a solid player in the space. While not immune to challenges, especially in times of recession, CubeSmart stands out as a potential opportunity for those seeking a steady yield and long-term growth. And REITs are really an excellent investment vehicle, offering a fantastic way to invest in real estate without the hassles of mortgages or dealing with landlords and tenant responsibilities. Now, CubeSmart is a great example, providing solid dividend growth and potential for the self-storage space. But there's another REIT I believe is undervalued right now with an impressive dividend growth history, and that's Realty Income, ticker O. I've been adding to my position in Realty Income in my Roth IRA this month, and I'm so convinced of the opportunity it's at right now that I decided it deserves a video all on its own. So click here to check that out. And until next time, my friends, keep investing.